Hello and welcome to CIMA F1 Financial Operations, your Chapter 6, which covers three standards, IAS 16, 23 and 38. 16 non-current assets, 23 borrowing cost and 38 intangible assets. We will focus this recording specifically on non-current assets, IAS 16. The best place to start this chapter is with a definition. And back to our framework document, if you remember our first video, we were saying what is the definition of an asset, and in order to talk about recognition criteria to recognize that element in the financial statements, we need first to meet the definition elements criteria. So let's recap quickly. The definition of an asset, it's that is controlled by the entity. It generates an inflow of benefit to the reporting entity, and also we are saying it's a result of the past event. So this is the definition, and as long as we meet this definition, and there were two criteria of recognition in addition to that, then we recognize the element in the financial statements. What were the other recognition criteria? Well, this particular benefit had to be probable, with a highly likely chance to happen, and also at the same time we were having to be able to put a monetary value to that particular item so that we reflect it in the financial statements. So as we move on into your express notes into the chapter, you will see that IAS 16 property, plant and equipment does not cover two aspects: the inventory, which has a special standard IAS 2, and obviously these are assets that would they would have to generate cash in a period shorter than 1 year, whereas non-current asset would stay with the corporation and generate benefits over a longer period of time in excess of 1 year. And also IAS 16 does not cover the assets held for sale, and that is the case of having a separate standard for those particular assets, and that is called IFRS 5. Now, how the standard is structured in a logical flow, it starts with saying initial recognition, and I already mentioned that. You have to meet the definition elements, and also the fact that you can put a monetary value and you have a probable benefit. At the same time, it's very, very important to know that it is common for subcomponents of a single non-current asset to be unbundled into separate non-current assets, where each has a materially different useful life. So get ready for this IAS 16, property, plant and equipment, to use it and think, if you have, let's say, a plane with different elements, and plane itself is a non-current asset, but because many of its parts have a materially different useful life, that particular non-current assets will be unbundled into separate non-current assets, such as chairs, for instance, versus the engine. So all these elements, you could ultimately look at them and they would clearly have a different useful life. You would have them unbundled and dealt with them individually, separately. Now, very important with the initial valuation of your non-current assets, let's say all costs can be included in the value of your non-current asset in your statement of financial position, as long as they are directly attributable to bringing the asset in location and conditions for its intended use. So the question you'll have to ask yourself, is that particular cost directly attributable to my asset in bringing it to location or in the current conditions of use? So for instance, site preparation, I think it goes without saying that you can include it in the initial valuation, which means that particular value would go debit non-current asset, credit payable or credit cash. And you would see the site preparation, you would have here sort of specific costs. So we tried here to give you certain examples that come straight from the standard and help you understand what you can and what you cannot include in the value of the non-current asset in its initial valuation. Irrecoverable, very important to think of irrecoverable import taxes. So that means all taxes that may be chargeable except VAT, which you may know, value-added tax. It's a recoverable tax, so that is not included in the non-current asset value. What else? Inwards delivery charges. We say, okay, you have this inwards delivery charges, you have them here. Think of deliver inwards when you see that word, because I think delivery charges, you can guess, are referring to delivery costs coming into your company, inwards, into your company. That must be the delivery cost charged by the supplier on the, let's say, raw materials you purchase for your production. And just in terms of terminology, if you have inwards delivery costs, you may have outwards delivery costs, and this outwards delivery cost would refer to the cost you charge outwards, outside your organization, towards your clients. So if you see inwards and outwards delivery costs, hopefully you know what they mean. Any inwards delivery cost can be, should be included in the initial valuation of your asset. And then you may have things like professional fees, things like attributable borrowing costs, and let's see what we do with them. If you talk about these attributable borrowing costs, you will have a special standard dealing with it, and yes, they can be included in the initial valuation. But pretty much you will read further by yourself on IAS 23 in this chapter. You have to have that loan specifically taken to support the manufacturing and preparation of that specific non-current asset, and then the interest related to that specific loan can be capitalized, including the non-current asset value. Alright, what you cannot capitalize, in other words, you're saying directly with their value debit expense rather than debit non-current assets, would be things like training costs, and we're saying there are any abnormal costs in installation. So any abnormal costs, unexpected, they would just be period costs. Okay. This being said, it gives you an idea of what things to play with and exercise some professional judgment whether they are included or not in the initial valuation. I think the best thing to help you in that respect is to remember that definition or guidance: all costs directly attributable to bringing the asset in location and conditions for its intended use. This is an area where you can debate a little bit, and in practice also there is a bit of a debate going on, but make sure you go back to that sort of guidance provided by the standard. Now, if we talk about the right of period, all we have to do is to make sure we understand depreciation, and I think we all know what depreciation is. When you purchase a non-current asset, you are including it in the financial statements, debit non-current asset, credit payable or cash, and you haven't recycled it through income statement of comprehensive income straight away. Why not? Because you have to comply with the accrual concept, which says matching the expense of that asset to the period over which that asset generates revenues. So if that non-current asset is staying with your organization for 5-7 years, you would have to create a matching exercise between the total expense and stretch it and defer it over the same period of time for which it generates revenues. And that is accrual accounting, requiring such an approach. Once you decide the useful life, make sure you review the useful life periodically. You don't have any specific guidance what means periodically, but imagine it can be something like every year or as often as necessary if you decide to change useful life, let's say as management. And maybe remember, based on your knowledge of IAS 8, you can change the depreciation method if you have to, if you think it reflects more of a true and fair view, let's say from straight line to diminishing balance or sum of digits. But in this case, you would have to make sure you know, according to IAS 8, how you treat a change in accounting estimates. And that is very much affecting present and future, and no retrospective change is required. All right, so we talked about initial valuation, we talked about the write-offs. Let's mention some buzzword here. Impairment. Well, we have a full standard on impairment called IAS 36, impairment of assets. But just to give you a glimpse of what impairment is all about, we are talking about situations where our non-current assets, and think in particular land and buildings, would be suffering a decrease in value. In the current economic context, it's very typical to have your non-current assets, particularly building and land, at a lower value, isn't it? Because the market is not moving and their value is lower. And usually in time, the value of non-current assets could go high and high and high, like we had a bubble created up to 2008, and then sometimes due to market conditions it can go down. So it's fluctuating over time, hopefully not in too short time, but the fluctuations will always be there. And these movements, from a company's perspective, you want to reflect the non-current assets at their true and fair view in a prudent fashion, but ultimately when you go to a bank, the net worth of the company is based on the value, also on the value of your non-current assets. It depends on that. So the better value you have, the more updated value you have, and the higher the value of your non-current assets is, the better your company will look like if it's higher. Let's say in case they want to get a loan. So what do? In case the value of your non-current assets goes down, though, impairment means a decrease in value. What you have to do with that decrease is to go directly into your statement of comprehensive income, unless that particular asset was revalued in a previous period. If that was the case, so in previous periods you have some upwards revaluation, then what you do first is to reduce that particular revaluation, revaluation reserve, which relates to that asset, and then just the difference will go, if there is any difference left, will go in the statement of comprehensive income. Okay, I hope that makes sense. We'll have a full standard to cover IAS 36 on impairment, and you'll get a better feel for the decrease in value of the assets and how we account for that. Now, as we said, impairment is the bad news. The value of your non-current assets decreases. Revaluation is the good news, when the value of your non-current assets increases. What do you have to do here? First of all, remember, it's a choice. As a company, you don't have to. It's not a must to revalue your non-current assets. You do have a choice now, so you can choose to revalue your non-current assets. And of course, like we said, if the value of your non-current assets is steadily increasing, you'd like to show a stronger statement of financial position. So if you do choose to do that, to revalue your non-current assets, you must make sure that you must revalue all property in the same class periodically. That has to be done. When we say periodically, in fact, it's annually more precisely. And also you have to disclose details of the evaluation, how it's been done, to directors and other stakeholders. Ideally use independent evaluators. Also very, very important, if you made your choice to revalue, you can never return to the historical cost later. So it's not like I'm going to elect to do revaluation because market is great, I'm looking better as a company. Oh, but the market is bad now, I'm going to elect to go back to historical cost. No, no, no. That is not possible. You're going to keep revaluating if that was your initial choice. Okay. I think that's just to give you a glimpse of things in terms of revaluation. Let's briefly mention on what happens with enhancements. Enhancements are where you are investing in a non-current asset, and in effect the earnings generating potential is increased, is affected positively. So you'll have such investments whereby, let's say, you have a building and you are extending that building and creating maybe a new, I don't know, maybe an extra room or extra space in effect to undertake activity. And you could argue that extension of the building will enhance the earning generating capacity of that building. So in that case, we talk about the famous capital expenditure or CapEx. And if you can prove that the value generation capacity is enhanced, is increased, then this capital expenditure is increasing the non-current asset value, is capitalized. So let's say you've made a capital expenditure with this expansion of $1 million, your double entry for that would be debit non-current asset to which it relates, and credit payable or cash. So that's your capital expenditure. But also sometimes companies don't necessarily do enhancements, but they do, for instance, invest just to maintain that non-current asset at the normal level of activity, such as, for instance, repairing hardware. Such cost would be called OPEX, operational expenses, and they must be expensed immediately. Of course, you have to know to do your disclosures for the exam. It's very, very basic. All we are saying is you have to present a detailed note of your property, plant and equipment, and pretty much a reconciliation from the start to the end of the year. So what you're doing, you're taking different classes of non-current assets, different types, so class 1, class 2, class 3, and so on. And basically you're planning to say, okay, this was the cost of each class of asset at the start of the year. This is the accumulated depreciation for each category group of assets. And therefore, if I say cost less accumulated depreciation, I get what we call a carrying value or a net book value between those. So why would we present such information? Of course, besides that, you may have some revaluation that you may have to account for, or some decrease in value of your non-current asset. You may also have some disposals of non-current assets that would affect the respective class from which you sold. Why we prepare this? In order for stakeholders to have better information, clear understanding what happens to what is supposed to be some material items into your statement of financial position. Was there movement? What did you dispose of? Have you made any revaluation? To which class of assets it refers? And so on. That's about it on IAS 16. I hope you enjoyed. I hope it gives you a kick just to learn about it and practice and apply to your questions. Good luck with studying, with prepping, and look forward to being in touch with you on the next topic.